Thanks a lot for joining us for another webinar organized by Princeton for everyone worldwide. Today we will talk about the new review of the Federal Reserve. And we have with us two prominent former central bankers, William Dudley, former president of the New York Fed, and Carolyn Wilkins, former deputy governor of the Bank of Canada. Both have written a report for the group of 30 they will present today. Welcome, Caroline and Bill. Thanks for joining us. So before we start, I will give a few opening remarks. So there's a new review, and I think let's put that in the light. What's different now? That we can of course fight the last war, but the next war, what are the big challenges coming forward? What is different is, of course, we have a huge public debt level, in the highest in peacetime. And of course, there will be some pressure of monetization, and this might create then just expectations might create some inflation pressure. So the independence of central banks is at the first order to safeguard against that. So that's one new difference. Another difference is, of course, financial stability. We have seen a lot of turmoil and liquidity incidents in the government bond market. And of course, there is, of course, a role for central banks as well to intervene and stabilize, and that's an important role, might interact with monetary policy, and we will hear about that too as well. And the third thing is that, we have huge central bank losses at the moment. That comes also from the interest on reserves. So there's now direct organic link between monetary and fiscal policy, because if you pay interest on reserves, you immediately have fiscal expenses as well. So there's a big challenge coming from that side as well, and might also cause tensions towards the central bank independence. So I highlighted here the central bank independence as one of the important elements in the review, which is probably not necessarily directly for the framework, but I think it's something one has to keep in mind all the time. Now, if you think about monetary policy, there are different objectives and interactions across the instruments. Of course, there's the price stability and the employment objective, but of course, financial stability is also important. I marked it a little bit in smaller letters here because it's not the official mandate of the Fed, but in general, central banks are founded for the reasons to create financial stability or ensure financial stability. The different instruments, we have a much bigger toolbox after the global financial crisis. We have interest rates on reserves. There can be different between the required reserves. Typically, it's zero on the required reserves, and then there's interest rate on the excess reserves. We have a lot of balance sheet policies, QE, QT, open market operations. And the question is, should we do QE only at the zero lower bound or the effective lower bound or the reversal interest rate? Or should there be a QE quantitative tightening rule, which is guided much more like a rule? It's not only kicking in when we hit the zero lower bound or not. And so, of course, QE measures has huge implications how duration risk and interest rate risk is distributed. Just if I show here, if you just look at some balance sheets here, that is the central bank holding some government bonds, also issuing some reserves. Some of these of the long-term bonds are also held by intermediaries. Some of them are held by households. And if now the QE measures leads to a purchase of long-term bonds from the households, they will actually go down and will be replaced with deposits. And of course, intermediaries, the banking sector has to issue more deposits and gets in exchange some reserves, which are then issued by the central bank. So whenever you do QE and you buy the long-term bonds from the households, the banking sector is automatically involved as well, and the deposits of the banking sector is going up. So essentially what's really important to understand is interaction across the different measures. And I have some work with Andrei Alexandrov where you show that if you do a lot of QE, what happens is that you redistribute the duration risk, the interest rate risk differently. For example, you take away this duration risk from the private sector. And if you want to cool down the economy subsequently after some QE measures, you have to be much more aggressive in your interest rate policy in order to have the same effects. Because the duration risk is taken out of the private sector onto the central bank's balance sheet. And in order to have the same effect as before, you have to now hike the interest rates much more dramatically. And that's why what we have seen, the Fed was hiking the interest rate a lot, but it didn't do so much because essentially a lot of the duration risk was actually was moved to the central bank's balance sheet. Secondly, you can also think of QE as a more preparing for the optimal QE, such that when you hit by a shock, that you have the optimal distribution of the duration risk in among the private sector, between the banks and the households, and also with the official sector. So when you then have to hike or cut interest rates, you hit all the targets: price stability, financial stability, and employment. And that's a much richer QE rule in a sense, where you have to take all of these objectives into account, and you have to fine-tune then the duration risk and the distribution of the duration risk in the economy. So with these few remarks, I would like to open the discussion, and with William Dudley and Carolyn Wilkins, who then first present the report, and we will interject those questions as we come along. And at the end, we have a QE thing as well. So I guess William Dudley will start, and then Caroline will take over, and we go back and forth. The floor is yours. And
thank you, Marcus, and thank you for giving me the opportunity, and Carolyn, the opportunity to be on Markus Academy. We applaud what you're doing, and it's a great program that you've developed. So what I'm going to do today is talk about our report that we published yesterday by the group of 30. The report, as always, it's not just Carolyn and I as the main authors. We also had a lot of helpers. The working group consists of Mohammed El-Arian, Jacob Frankel, Mervyn King, Guillermo Ortiz, Masaki Shirakawa, and Yigan. You see there's quite a few central bankers on the list from a large variety of countries. And I think that they allowed us to evaluate the Fed's monetary policy framework review in the context of what other central banks are doing around the world. And I think that makes the report richer for that. So what's the purpose of the report? So what we're trying to accomplish is to evaluate the 2020 framework that the Fed introduced right during the COVID pandemic in light of the lessons learned from COVID and the aftermath. As we'll see, the 2020 framework was put in place in part because of what we experienced following the great financial crisis, and was probably fit for purpose then, but turned out to be not so fit for purpose for what happened during the COVID pandemic. In our report, we focus on three dimensions. One's what's the Fed's objectives with respect to employment and inflation. The Fed did change their objectives in 2020, and that's relevant for whether they should make additional adjustments in 2025. We're going to talk about the tools and operations that the Fed uses to achieve those employment and inflation objectives, and also the communication strategies the Fed uses to manage expectations. Communication from the Fed to the markets is very, very important, because that's a way that the monetary policy impulse is communicated through financial conditions. So getting communication right can make monetary policy more effective, and make monetary policy work more quickly in terms of getting priced into financial asset prices, and also can improve the accuracy of that transmission. So getting the communication right is really important. The final purpose of the report is basically to make our recommendations that we think would improve the Fed's monetary policy framework, and we're trying to contribute to the debate as the Fed goes through the process of evaluating how to update their framework. In this light, they're having a research conference at the Federal Reserve in a couple of weeks. I know Marcus and I are going to be attending that. So it's going to be interesting to see how what we say today tracks their own thinking at their research conference at the Board of Governors. So let's start with the key features of the 2020 framework. So the 2020 framework looked at the experience post the Great Financial Crisis and made some important changes to the framework. The first change was the Fed introduced a flexible average inflation targeting framework. So this introduced several changes from its prior strategy. The reason why they made this change is that the Fed was concerned about the risk of interest rates being stuck at the zero lower bound, inflation falling, inflation expectations falling, and that making monetary policy tighter and tighter, and making it more difficult for the Fed to generate the kind of monetary policy stimulus that would get you out of that kind of environment. So the Fed made two important changes to how they thought about their objectives of employment and inflation. The first change is that they said that we're going to now redefine our employment objective to minimize shortfalls from maximum employments. So this means that we're going to basically try to push the economy to maximum employment and sort of see what the limits are of how hot we can run the economy before we tighten policy. By doing this, that reduces the risk that the economy, that inflation, falls below the Fed's 2% objective. It reduces the risk that inflation expectations become unanchored to the downside. So that was why they made that change. The second important change that they made was to their inflation, how they think about their inflation targets. They now did a makeup strategy so that when periods under which inflation had undershot the target, they now committed to overshoots of the target to offset those prior undershoots. During the late, from 2010 to 2019, the Fed basically fell a little bit short of its 2% inflation objective over that period. So there was a cumulative undershoot. The Fed was worried about the consequences of that for inflation expectations, which were also a little bit below the Fed's 2% objective. And so the Fed said, we're going to take care of that problem by committing to make up any shortfalls. And by doing so, that should keep inflation expectations better anchored. The framework did not make substantive changes to a whole variety of other areas where the Fed could have made changes in 2020. Quantitative easing or tightening, there was no framework introduced to manage that issue. Communication policy were not changed in any meaningful way. The summary of economic projections was left largely unchanged. There were a few fan charts introduced at the back of this summary of economic projections, some tables on uncertainty and risks to the outlook for inflation and unemployment. But generally, Fed communications were left unchanged. The Fed kept the short-term interest rate target to be the federal funds rate, even though the federal funds rate was becoming increasingly idiosyncratic. And there was no emphasis on coordinating monetary policy with bank regulation and financial stability objectives, coordination that I think in hindsight would have been useful to help maybe prevent or minimize the risk of the 2023 regional banking crisis.
Can
So
you just ask a
how
quick
did this
question
all...
about the makeup period? It was actually not even specified what the average is taking over. No, it's whether it's 2-year, 10-year.
Yeah, it was very
Okay.
vague. You're absolutely right. It was very vague. It was, we're going to make it up, but we're not going to tell you how fast we're going to try to make it up. We're not going to tell you how far back in time we're going to look for in terms of the makeup. So there was a bit of a hand waving in terms of how this was actually going to work in practice.
And was it
So
clearly specified whether it's, you make up undershooting, but overshooting of the inflation you will not
you
make
don't
up?
make up overshooting. It's bygones on if rates are over 2%, and it's no bygones if rates are under 2%. It's interesting. I've been having a little ongoing debate with Don Cohn about whether this raises the average inflation rate. My view is that this probably raises the average inflation rate, because if you're going to offset misses to the downside but not misses to the upside, that tells me that maybe inflation is now going to average a little bit more than 2%. It's interesting. Don sent me some material yesterday, which showed that the Fed says that they're still committed to 2% inflation, but if you really strictly interpret the asymmetry of bygones, it does suggest that inflation would average over 2% over time. So, what were the consequences of this? Well, one thing that happened that turned out to be pretty important was the way the Fed operationalized this new framework. They basically said, we're not going to raise short-term interest rates off the zero lower bound until we are convinced that we're at maximum sustainable employment, we're at 2% inflation, and inflation is going to be above 2% in the future. So this created a situation that in early March 2022, the Fed was still buying securities, interest rates were at zero, the economy was growing fast, inflation was rising over 5%, and the Federal Reserve was still stuck at 0% interest rates. So monetary policy was very accommodative at a time that the economy was overheating. So the design of the flexible average inflation target regime reinforced the bias for the Fed to be late in terms of a tightening monetary policy. In my view, the ideal monetary policy tries to reach neutral. At the same time, it reaches 2% inflation and full employment. And if you do that, you can just then stay there. That's pretty much where we were in 2019. But the Fed's the framework review in 2020 sort of changed that. You can see here in Figure 1A, how slow the Federal Reserve was to react to the surge of inflation. Inflation was pretty close to the peak at the time the Fed was just about to lift off from zero. So this is a chart that from the Fed's own monetary policy report to Congress, which sort of shows what the Fed's monetary policy rules said they should do versus what the Fed actually did in terms of interest rates. So this is the Fed's own report. And what it shows you, if you look at the Fed's monetary policy rules, there's several rules that are shown here, that all the rules suggested that the Fed should lift off basically in early 2021. And in fact, the Fed didn't actually lift off until early 2022. So the Fed was about a year later lifting off than what their monetary policy tools. And I think the framework that they had, the flexible average inflation targeting and how they operationalized that contributed to it. That wasn't the whole story. It's also a bad forecast. The Fed was surprised by the strength of inflation, how inflation rose. They were surprised by how strong the economy was. So it wasn't just the framework. The forecast obviously also contributed, but I think the framework was a factor here and needs to be considered in reevaluating this framework going forward.
How important do you think was the sequencing that they were first wanted to finish the QE measures before they raised the interest rate?
Yeah, they reinforced their bias to be late in a couple other ways that you're just mentioning. Number one, they basically said that we can't raise rates until we finish QE, because obviously if we're doing QE, we're providing stimulus, so there's no real reason to raise rates until you're finished with QE. And then they also said, well, we can't just end QE abruptly, we have to taper QE. And so the commitment to taper QE, the commitment that we can't lift off until QE is finished, also kept pushing back the timing of the first rate hike.
In a sense, this sequencing was an implicit forward guidance, in a sense.
Well, the Fed was basically, anchoring expectations essentially that they were going to be late. And, that provided additional monetary policy stimulus. But it's clear that the economy didn't need additional monetary policy stimulus at that time. This is a period of time when we were coming out of the pandemic, vaccines had been introduced. The Biden administration in the spring of 2021 passed a $1.9 trillion fiscal package. So I think, with the benefit of hindsight, and hindsight's obviously always 2020, the benefit of hindsight, the Federal Reserve should have tightened monetary policy sooner. So what were some of the other unanticipated consequences of the Fed's actions? Well, as you were showing in your slides that you presented earlier, Marcus, when the Fed does quantitative easing, it basically blows up bank balance sheets. So when the Fed buys a security in the private market, that person who has the security now has cash. You can buy another security from someone else, but then that person has cash. Eventually, that money finds its way back into the banking system in the form of deposits. This chart here, Figure 5, basically shows how commercial bank deposits rose very rapidly between the start of QE and the end of QE. And that wouldn't have been a problem if banks had just taken those deposits and invested in short-term fixed income assets. But in fact, some banks took that surge of deposits and invested in long-term fixed rate assets, treasuries, agency mortgage-backed securities. And in some cases, they used the money to make long-term fixed rate mortgages to their clients. Now, that turned out to be a problem because basically the deposits turned out to be very volatile and short-term in nature. And the assets turned out to be, fell sharply underwater as the Federal Reserve raised rates and long-term interest rates rose. The net interest margin of a few banks that made these interest rate bets on long-term fixed rates assets became very constrained. And in March of 2023, we had a bank run on a number of regional banks, so much so that several regional banks, Silicon Valley Bank and First Republic Bank in particular, failed as a consequence. Now, I don't think the Federal Reserve is responsible for the bank's bad behavior. The banks made the mistake of taking short-term deposits, investing in long-term assets. But the Fed contributed to the financial instability by flooding the banking system with deposits, not using supervision to essentially prevent banks from doing stupid things with the deposits. And the fact the Fed was late to raise short-term interest rates meant that they had to raise interest rates more sharply and higher. It was the most rapid monetary policy tightening since the 1980s. And so that created a greater squeeze on the net interest margins than would have happened if the Fed had tightened earlier and not had to go quite so high. The other unintended consequence of QE was the fact that the QE generated a lot of losses for the Federal Reserve. As the Federal Reserve was pushing up short-term interest rates, the cost of its reserve payments started to dramatically exceed the earnings that the Federal Reserve was earning on the long-term fixed income assets it bought, treasuries and agency mortgage-backed securities. So the Fed Reserve was also running a very big negative interest margin. And to date, the losses are almost 230 billion, 224 billion as of March 2025, but the losses are continuing to climb. In terms of opportunity costs, the losses are actually quite a bit larger, because if the Fed hadn't done QE, the Fed would have continued to earn positive income. So the total cost of QE during this episode is probably going to be somewhere between $500 billion and $1 trillion. So a pretty expensive program. The Fed did not anticipate this kind of large losses. The chart you see here, Figure 6, basically looks at what the system open manager account was, the New York Fed was projecting in terms of SOMA income in the spring of 2022. This was published in the spring of 2022. Basically, they expected the baseline would be that the Fed's earnings would go down a bit and then recover. They put in two alternative scenarios: interest rates 100 basis points higher than they expected, and interest rates 100 basis points lower than they expected. Obviously, if interest rates were lower, the Fed has lower losses. They had higher earnings. In the case when interest rates were 100 basis points higher, there's a small dip into losses for a very short period of time. The problem, of course, was that interest rates weren't 100 basis higher than what the Fed was anticipating. They were 300 or 400 basis points higher. So it turned out that the interest rates were much higher than the Federal Reserve expected, and so the losses turned out to be much larger.
Can I ask you a quick question there? Because Mark would like to know, if you look at the losses, how does it compare historically? Are these the biggest losses the Fed system ever made historically?
Oh, absolutely. There's nothing like this ever before. I mean, the Fed did QE during the Great Financial Crisis, but you remember, subsequent to the Great Financial Crisis, interest rates were very low over the subsequent decade. So there was never the tightening of monetary policy that pushed up the cost of reserves above the return on the assets. So the Fed's experience post the Great Financial Crisis, they had nothing like this happened at all. You can see, how the SOMA income was, quite positive in 2012, 13, 14, 15, 16, 17, and 18, because interest rates stayed low, because short-term interest rates stayed low. It was only the dramatic rise in short-term rates that caused the Federal Reserve's net interest margin to collapse and become sharply negative.
So, but can you elaborate a little bit now? We went away from the corridor system to a floor system. We pay interest on reserves since 2008. Is this a direct consequence from moving to a different regime in 2008 to pay interest?
No, I don't think so. I mean, the Fed can run a large, reserve. Can have a system with large excess reserves, large reserves in the system without having any interest rate risk, as long as it holds short-term fixed income assets. If the Fed had lots of reserves and all those reserves were invested in Treasury bills, there would be no, interest rate risk exposure. So it's really the consequence of the fact that the duration of the Fed's liabilities is very short term in the case of reserves, not short term in the case of currency, which is outstanding, indefinitely. And then the assets on the other side are very long term. It's that maturity mismatch that creates that risk to the Fed. But the Fed could, in principle, manage that by not holding long term fixed rate assets.
And if you look at the consolidated balance sheet between the Treasury and the central bank, would say, these are losses by the central bank, but on the other hand, otherwise.
Well, yeah, I mean, the Treasury basically does what it's going to do in terms of debt management. Generally doesn't really adjust its debt management practices, in response to changes in the economic environment. It tries to keep its duration pretty steady, the average maturity steady. And when the Fed intervenes and does quantitative easing, it's essentially undoing some of what the Treasury is doing in terms of a collective government. So when the Fed basically, to the point that you made very earlier, I mean, when the Fed is buying long-term fixed income assets, it's essentially shortening the average duration of the assets held by the general public. This is how it's been done. In principle, the Treasury, if it wanted to, could offset what the Federal Reserve was doing by deciding that we're going to issue more long duration fixed income assets. But obviously, if you did that, you would basically be undercutting the power of QE to provide stimulus to the economy. if you don't let the Fed remove duration from the market, then you're not actually having a downward effect on bond term premium, and therefore you're not having, providing additional monetary policy stimulus. So the Treasury historically has sort of said, we're just going to commit to our program. We're not going to respond to what the Fed's doing. The Fed, in the same way, takes the Fed's program as given and then does QE based on what it thinks is appropriate from a monetary policy perspective.
Thanks.
There are also some communication gaps. You raised one earlier about the flexible average inflation targeting and the lack of specifics. How long, how long do you look back to in terms of getting to average? How much of an overshoot of inflation do you tolerate? Another problem with the Fed communications gap is the summary of economic projections really focuses people way too much on the modal forecast. People are very focused on the SEP median projections on growth, unemployment, inflation, and interest rate dot plot. That modal forecast rarely is actually realized. And I think the Fed providing more information about what they would do if things evolved differently than expected would be actually very useful in helping explain to market participants and households and businesses what the Fed's reaction function is. Finally, in terms of the communications gap, the Fed has not really provided strong guidance in terms of how trade-offs between inflation and unemployment would be managed. Now, during the COVID pandemic, there was for a long time no conflict. Inflation was low and unemployment rate was high. But in the current environment with tariffs coming into play, there is going to be quite a bit of tension between inflation and employment. The Fed's probably going to be missing on both sides of its mandate. And guidance from the Fed on how to manage those trade-offs when they're in conflict, I think, would be very, very helpful.
Can I ask you a question about the dot plot? So some people criticize it because it doesn't really reflect a reaction function. It just says, what's your forecast? But it is, how would you react to that? Do you think that would make the dot plot exorbitantly difficult to have a reaction function in it? Or would you get the other extreme would get rid of it altogether?
Well, I think it's very hard once you've introduced something in terms of communication and made something more, increased your transparency to sort of pull it back. So I'll be surprised if the Federal Reserve, ditches the summary of economic projections. It's also an important way for the Federal Reserve bank presidents to communicate their views to the public. So I think they would probably resist having the summary of economic projections taken away. But to your point about the summary of economic projections has a fundamental flaw on it. You can see people's interest rate, inflation and employment projections, but you can't see how that directly ties to their interest rate projections. There's a bunch of employment and inflation projections, and there's a bunch of dot plots, but you can't tie the interest rate projections back to the economic forecast. You could solve this by basically disclosing, participant one, here's their interest rate forecast, and here's their economic forecast, participant two. In fact, the Fed, when they release all of this information about what the Fed has done at their meetings with a 5-year lag, they do actually disclose who is actually which dot and how that dot relates to the economic forecast. So you could do that. I think it would probably be mostly of interest to people like me and you. I don't think the general public is going to pour over the participants and look at these forecasts, but I think it's probably a reasonable thing to consider doing. We think a better approach, though, is to actually have a formal staff forecast with scenarios. We think that would help better in terms of allowing people to figure out what the Fed's reaction function is, not just in terms of the modal forecast, but when the economy behaves differently than expected.
And do you think the dot plots themselves discipline the regional Fed presidents not to claim some outrageous things, or how they vote and also how they make speeches? Because it has to be consistent with the dot plot revealed then 5 years later, or not?
I don't think we have I think that we have many voices, but I don't think the many voices turn out to create much confusion. I think people are broadly singing from the same hymn book. And I think people certainly understand that, Chair Powell is more important than anybody else by a significant order of magnitude. So what Chair Powell says at the press conference, what he says in his speeches, that really gives you a sense of what the committee is, where the committee is and where the committee is headed. And so I think the fact that we have many speakers, I don't think that creates a problem. I think having a diversity of voices is probably a good thing, not a bad thing. Go to the next slide, Marcus. So I want to turn it over to Carolyn. I've been talking for quite a while. I want to hear from Carolyn. She's going to go through the 6 recommendations that the group 30 working group made and talk about some other and talk in a little bit more detail about QE and QT, because this is a big gap that we think needs to be filled. Carolyn?
Thanks a lot, Caroline.
Yeah, thanks, Bill. So you just ran through just how forcefully the Federal Reserve responded to what were really extraordinary challenges of the pandemic, and they were operating under a lot of uncertainty. So this idea of the benefit of hindsight, I think, is pretty important. There are a lot of lessons here that are embedded in the recommendations that we made. It's interesting just how many of them are shared by other central banks, not all of them, but certainly from the G30's point of view, we are focusing on kind of the forward-looking aspect of the framework and trying to think about how can we make changes or recommend changes that would improve its robustness as well as its transparency and accountability. And when we think about robustness, it's kind of in an intuitive way that you would imagine. It's just a framework that's going to perform reliably across a wide range of economic conditions and be able to adapt to circumstances as they evolve. And so the very first recommendation in that regard makes a lot of sense, in the sense that we think that they should move back to a clear symmetric inflation objective. Certainly, the flexible average inflation targeting regime was a thoughtful response to persistently low inflation and worries about the zero lower bound. But it turned out, as Bill very well explained, to be quite ill-suited to a period of upward shocks to inflation. And it introduced some ambiguity along a few dimensions. Marcus, you talked about that. I think a symmetric target would restore clarity and anchor expectations, while at the same time supporting timely actions in the face of inflationary and disinflationary shocks. And so this idea of kind of building in being behind the curve would be eliminated.
Caroline, can I ask you, did any other central bank go for these make-up strategies of the flexible average inflation targeting, or that was very US specific?
It's quite US specific, and I think combined with the asymmetry or what we see as an asymmetry on the employment objective, those two things were unique. That being said, other central banks made very similar errors, but for perhaps different reasons. In the sense that, well, all central banks had big forecasting errors. You saw that in the Bernanke report, but central banks were very seized about the zero lower bound. And so it wasn't embedded in their framework, but certainly the risk that they wanted to avoid was getting stuck there again. And so that led to perhaps some underestimation of the upside risk to inflation, but also a hesitancy to be too ahead of the curve. I raised this employment objective. Now, the second recommendation is really about that. And in the current framework, it focuses on minimizing shortfalls from maximum employment. And in some sense, this seemed to reduce the flexibility to act preemptively. What we'd like is to see returning to an employment objective that's defined as the maximum level of employment that's consistent with price stability. I think this framework would restore a more balanced approach between the Fed's dual mandates. Certainly, it acknowledges that excessively tight labor markets can pose inflation risk even before price pressures are fully visible. And I think by doing this, it would enable the Fed to weigh the employment and inflation objectives simultaneously and symmetrically, especially when they're in tension. So it's really about this ability to building in the incentives to be preemptive on that side.
Can I push you on that a little bit to make sure that I fully understand it? Are you arguing for a lexicographic ranking, first price stability, second employment? Like the ECB has, there's a first order objective with respect to price stability and then a second order only. How should I interpret to be consistent with price
This is not meant to change the ranking. It's meant to keep the ranking the same. Look at the employment objective in a way that recognizes that inflation pressures can arise coming from the tight labor market and being preemptive about that. We think that thinking about shortfalls for maximum employment doesn't really get to that. Something that I didn't mention, but it is in the paper, is that they also had this other, not objective, but consideration with respect to how widely shared employment actually was. And so if there were shortfalls or perceived shortfalls in employment among certain groups of workers, that would be a consideration in terms of how Strident maybe would respond to that. And in our view, that's something that's really being targeting or thinking through that sort of micro version of full employment is just out of reach for the tools of monetary policy. And so moving back to something like it was before would be better. Now, if you that's outside of the recommendations that we're making, there certainly are some good arguments for having a ranking, but that's not where we've gone in terms of the recommendations in this report. So not unrelated is the third, which is really clarifying how trade-offs are going to be managed between these two objectives. There's going to be times sort of that, and especially now where inflation and employment goals are in tension, and certainly the current case is top of mind. We know that the Fed needs to retain the flexibility to respond in real time, and with the understanding that the inflation employment trade-off can shift depending on the source of the shocks or the macroeconomic context. But what's really important here is that the Fed explains how it is weighing those trade-offs, especially when there's uncertainty about them, so that the public and markets can interpret its decisions with confidence. We don't think that type of communication is clear enough, and the principles under which they would make those trade-offs are clear enough.
So this would go significantly beyond just clarifying what's the natural rate of unemployment. Is this correct? Because that's also a controversy. What's the natural rate of unemployment, in a sense?
Yes, it would go on. Obviously, we need to be clear about that, but then after that, it would be how are they making trade-offs? What are the nature of the trade-offs at the time, and how are they making them? So yes, it would go on past that. Mm-hmm. The fourth recommendation I'm going to come back to in the next slide, but it's about establishing a framework for QE and QP that extends it past what is viewed publicly today. Let me get back to that one. The fifth recommendation is really related to something that Bill already alluded to, which is publishing scenario-based forecasts. Certainly, the Summary of Economic Projections is a valuable communications tool, but it does remain limited in scope. And I think that a shortfall is really that it focuses on medians and baseline paths with little information about alternative outcomes or the conditions under which policy might change. This is a particular weakness when you have a period of high uncertainty or different kinds of shocks where the economic dynamics are nonlinear and really hard to forecast. Now, the Group of 30 recommends that the Fed regularly publish scenario-based staff forecasts, so there'd be a baseline, but also different scenarios alongside the Summary of Economic Projections.
Who would pick the scenarios? Because one problem was also the stress test scenarios, that the high interest rate hikes was never a real stress scenario. So is the staff also picking the stress scenario, or is the FOMC picking the stress scenarios?
It's different. Those who
to be determined. I think to be determined.
Ways in different countries, certainly. I think what's important in these scenarios is that they're not trying to mimic the scenarios that are done for real extreme tail risk necessarily, like we do with bank stress testing. I think another important feature of these would really that they would include plausible alternative paths for the economy including interest rate paths. Just as an illustration, how decisions might change under different economic evolution. And I think what this would do is not only help form discussions within the FOMC about where to set policy today and what the policy strategy is, but it will also help markets and the public better understand how the Fed might respond under different conditions. And that would improve, I think, transparency, but also credibility. It's something that was recommended in the Bernanke report as well. It's something that the Riksbank has already started, and so it's a work in progress, or to be determined, as Bill said. The final recommendation before I get back to QE and QT is to create a forward guidance playbook. Now, forward guidance has become an essential part of the Fed's toolkit, other central banks as well, and particularly when the interest rates are near the effective lower bound. And in recent years, the Fed has adapted its guidance to evolving conditions. They've done it thoughtfully, but sometimes the public understanding of its intent can be pretty limited. The G30 recommends developing a forward guidance playbook. So it's a transparent approach that clarifies when and how different forms of guidance may be used. And in particular, we think they should be distinguishing between calendar-based guidance, so like date, and outcome-based guidance linked to economic conditions. And each of them have its place, but a structured framework would help explain how the choice reflects the broader policy strategy. How do you interpret when they're using one versus when they're using another?
So can I push you on that a little bit too, in a sense that we go in a world with much more uncertainty? Do you think we should do more forward guidance or less forward guidance because we face so much uncertainty? And then there's always, Delphian versus Odyssean. Do we really want to commit ourselves and bind ourselves to a particular action, like the sequencing we did last time? Or is it more like a communication? Do you view forward guidance more as a communication tool or really something which binds you and limits your action space down the road?
So this was not part of the recommendation, so this is my opinion. I think under uncertainty, that very specific guidance is something that's dangerous, because you don't want to be in a situation where you're tied to the mast and you have to follow it to the extent that you're no longer able to achieve your target. And to the extent that you haven't caveated enough, then there's a big cost in terms of credibility or reputation if you drop it. And so to me, the safer path is to be very clear about your reaction function, and to the extent that you do more specific forward guidance, that it has the right amount of caveats. I think scenarios help you do that. Different scenarios, for sure, that ex ante that people are going to say, well, that's reducing the effectiveness of this forward guidance at an unusual time. But I think that what really matters is not just what happens in the short run, but what happens to your reputation and your ability to achieve your target over the longer term, which is my long way of saying I'm not sure it's worth it. Publishing forecasts that have an interest rate path in different scenarios with different interest rate paths, I think, is a better way to show how the reaction function works.
But of course, it makes the communication way more challenging because it becomes way more complex to communicate to the general public in particular.
But you have to think about who you're speaking with, because if you can layer your communications, the more complicated communications to the experts like you and Bill and market participants, and then they are the ones that transmit some of that through their analysis to the general public, then I think you have a hope. But trying to simplify things to the point that it gives people a false impression of simplicity isn't really, I think, a very good communications tool for a central bank. If it's complicated, it is, and so communicating that the degree of uncertainty properly is to me quite important. So, so this cost-benefit framework is something that's not unique to the U.S. and to the Federal Reserve, but I think it's quite important. When you look at the Fed's asset purchases that were done in 2020 and 21, they were made under extraordinary uncertainty, and like many other central banks, they were acting first to stabilize markets and then support the recovery. And obviously, the Fed and other central banks have internal frameworks that guided these decisions, but they weren't publicly articulated in detail. And it wasn't clear how these frameworks evolved as the conditions changed. And so I think that one of the things that's very common across the central banks is separating the design of the facility, especially the asset purchase facilities that were designed for restoring markets functioning, from those aimed at monetary policy stimulus. Communications weren't clear, and the design of those facilities wasn't targeted at those two different purposes. And given that QE is now a standard policy instrument, it seems to be here to stay. A more structured and transparent framework would support accountability by clarifying the rationale for decisions and how those decisions might change. It would also enhance transparency by distinguishing the objectives, setting clear expectations, and helping markets understand how these balance sheet tools fall into or sit within a broader public strategy. So in our minds, a framework would have some key elements. And the first one is the obvious one, which is clear objectives and communication that define the purpose of the program, why it's designed to achieve that purpose, and trying to explain this in plain language to the public. The second one is a little bit harder, and I think the one that needs the most work, and that's an evaluation of the expected net benefits. So ideally, what you'd want to end up with is conducting and publishing a full cost-benefit analysis before launching large-scale asset purchases. And this is easier said than done, but I think this analysis would go beyond the macroeconomic effects to include potential risks such as risk to financial stability or value at risk potential losses. It should also incorporate scenario modeling of balance sheet impacts under different interest rate paths. And crucially, this analysis or parts of this analysis need to be updated dynamically as conditions evolve so that decisions to extend or scale back or exit QE programs are continuously informed by a transparent assessment of the benefits and the costs.
It's very challenging to put different weights on different objectives, like, inflation objective versus financial stability objective. And it might also be highly non-linear. I might give up a little bit of financial stability, but not even in a crisis stage. You might be very sensitive to this. How would you capture such a framework in such a multidimensional objective?
You can layer on the financial stability, but even just thinking about the macro part. So what you see in the analysis is what it does to interest rates, maybe some about what it does for GDP and inflation. But even starting there and being clear about that, thinking about, well, what are the net costs if we end up in a bad scenario in terms of where interest rates go, and what would the net benefits be there? What would the fiscal implications be? And when you think about that, you think, well, then given just those narrow costs and benefits, is it better to use QE or is it better to use fiscal policy? So thinking about alternative tools, even though the Fed's not responsible for those other tools, just having that analysis is a way to structure a conversation about it. And how policy decisions are made, yes, for sure, there are trade-offs potentially between financial stability and the monetary policy objectives in the short run. But I guess the way I would approach it is trying to model it and think about where you come out given different weights. the advantage of having a framework, even though it's imperfect, is it adds some structure to the policy discussion that I don't think is quite where it should be right now.
Thanks.
I guess the other part of it is the exit strategy. You've already talked about it a lot earlier, but it's really thinking about flexible but clearly articulated criteria for tapering or ending QE. And this can be based on inflation, labor market progress, or financial conditions, and trying to think through different exit strategies under different scenarios to avoid rigid sequencing unless somehow it's really justified by the conditions.
Do you also go into what's the optimal size of the central bank's balance sheet? What are the criteria? How many trillions?
So I guess this is the last part of the framework, which is just thinking about the long-term vision for the balance sheet. Right now, there's a lot of open questions in terms of the Fed's targets, balance sheet in steady state, how much reserve supply is optimal, what role should MBS play in there. I think that where that all settles out is to be determined, but that's something that should be part of the framework so that it can inform the strategy if we have to do this again for QT, and it would reduce the ambiguity around asset holdings. So, what would be the criteria? That depends on what the Fed decides in terms of their operating framework. But clearly, the bigger the balance sheet, the more impact it has in markets, and maybe not always for the better, the more it encourages financial institutions to rely on the Fed as opposed to interacting within themselves. And so at the same time, if they go too low, then they're going to have some implications for their ability to control the rate. And so I think that those criteria are going to have to be evaluated by the Fed. So, so maybe I just pass it back to you, Bo.
Okay, thank you, Carolyn. So the Chair Powell has indicated that the 2025 framework review will not include evaluation of the Fed's monetary policy tools or changes to the 2% inflation target, the 2% number. But that doesn't mean that there aren't some other changes that should be made. But let's start with the 2% inflation objective. There is a bunch of debate that people have been arguing that maybe we should raise the inflation objective from 2% to 3% or 4%. Jason Furman, Olivia Blanchard have talked about that in the past. And the idea of having a higher inflation target is that you would then have more room to cut rates to fight an economic downturn. There'd be less risk of being constrained at the zero lower bound if the inflation target were higher. Powell has indicated pretty clearly that their Fed is not going to change its 2% inflation objective. And we agree with that decision. We think that changing your inflation objective at the current time would be inappropriate, because if you did so, you probably would unanchor inflation expectations. People would perceive it as the Fed's changing their target because they can't achieve 2% inflation. So we think this would undercut the Fed's credibility. We also think the benefits of a higher inflation target are not quite as high as they look like to be a few years ago, because most people's estimates of R-star, this neutral federal funds rate, consistent with a neutral monetary policy, has risen. So whereas the Fed thought neutral was a 0% real rate a few years ago, now they think 1% is a neutral real rate. That means that you have a little bit more room to cut rates to avoid being pinned at the zero lower bound. The fact that the federal funds rate is 4.25% to 4.5% today, economy seems to be doing pretty well pre the tariff shock. I think that just tells you that the zero lower bound risk is not as salient today as it was in the past. So we support the decision to stick with the 2% inflation objective. But there are a few other things that we do think should be changed. For example,
can I just ask you, have you thought about going more negative or going into a negative territory like the ECB, the Swiss National Bank, and Sweden did? Is this part
Well,
of
we did
your
we
thinking?
did not evaluate that in our framework review because the Federal Reserve has pretty clearly made the decision not to go into negative territory. I mean, they had two opportunities to could do it following
Mhm.
the great financial crisis during the COVID pandemic, and Fed decided not to do it. I think my own recollection of when I was the Federal Reserve Bank president of New York and sitting on the FOMC committee is one reason why the Fed didn't want to go negative was one, the benefits were pretty small. You can only go so negative before people start to hoard currency. And so it's not like you get a tremendous about additional power of going negative because you can only go negative to maybe 0.5% or -1%. And number two, I think there was a feeling that if you push interest rates negative, you start to create other problems for yourself in terms of the capital markets. You might really damage the money markets. What would happen to money market mutual funds if you start to have negative interest rates? Would all the money flow out of money market mutual funds? Would you put that industry out of business? So the Federal Reserve, I think, using abundance of caution, decided let's just stick with zero, and not go into negative interest rate territory. I mean, it's the same vein. The Fed thought about yield curve control, which was pursued by the Bank of Japan and the Reserve Bank of Australia, decided not to do yield curve control because I think the Fed was worried about how the exit would work. Not to say yield curve control doesn't have some pretty attractive characteristics. If you have a credible yield curve control strategy, you actually don't have to buy that many securities because if your threat to peg the rate is credible, that reduces the volatility of that long-term fixed rate asset and makes it pretty attractive to hold. So we're basically assuming that the Fed's not going to do yield curve control, not go to negative interest rates, but obviously those things are always on the table. So the three things that we'd like to do, in addition to what the six formal recommendations are, is one, we'd like to junk the federal funds rate as the Fed's target variable. The federal funds rate market is increasingly idiosyncratic. It's basically reserves that are held by government-sponsored enterprises like the Federal Home Loan Banks, Fannie Mae and Freddie Mac, selling those reserves on which they're not allowed to earn interest to foreign banks that can earn interest on reserves. That's really what the federal funds rate market is right now. So it's not a very relevant market in terms of money markets. We also feel that with the Fed now having the interest to pay interest on reserves, that's sufficient. That's the instrument that the Federal Reserve can use. There's no real need for a federal funds rate target at this point in time. And if you eliminate the federal funds rate as a target, you don't need things like the reverse repo facility, which was introduced by the Fed in 2013 for one reason and one reason alone, to put a floor under the federal funds rate, so the federal funds rate would never trade outside the target range set by the Federal Open Market Committee. So if you no longer have a federal funds rate as your target, you no longer have a range, you no longer need to have a reverse repo facility. So it just makes monetary policy execution a bit
But
simpler.
just to clarify, so money market funds would always then also get the policy rate because they cannot hold reserves. No. How do you ensure that?
They're not getting the policy rate, but they're getting they have the option of getting the reverse repo rate, which is slightly below the interest on reserve rates.
But would you get
So
rid
that
of
was
this
done.
option for the money market funds? No, you
Well,
would keep that.
the option was introduced not because the Fed was trying to do favors to the money market mutual fund industry. It was introduced to put a floor under the federal funds rate,
Yes.
so the federal funds rate never trade outside of the specified range of the FOMC. So currently, the FOMC says that the near Fed is supposed to keep the federal funds rate in a range of 4.25% to 4.5%. The Fed was worried that without something that put a floor under that rate, the federal funds rate could trade soft below the bottom end of the range. That's why the reverse repo facility was introduced. If we stop targeting the federal funds rate, we don't need the reverse repo facility. It just makes monetary policy a lot
But just to make
simpler.
clear to myself, it could be that the banks earn on the reserves it's 3-4%, but the money market funds, because they might not have to getting 3-4%, then they might be just getting 2%. That would be a feasibility then? Or?
No, but there's a lot of arbitrage. I mean, if the rate on reserves is 4.5, then Treasury bill rates are an alternative for banks, and so we've seen it pretty clearly that when the Fed moves the interest rate on reserves, all the money market rates move proportionally. When the Fed first lifted off, following the great financial crisis, the Fed was worried that when they raised the interest on reserves, other money market rates might not follow one for
Yes.
one. But in fact, once they actually ran the experiment, raised the interest on reserves, money market rates moved up in tandem. So I think we've sort of demonstrated that the interest on reserves is a sufficient tool to move money market rates around more broadly. And so in that environment, you don't really need the federal funds rate anymore as a target variable. The second thing we want to do is we want to fix the supplemental leverage ratio, which is a leverage ratio for bank capital. Basically, it basically says that banks need to have capital of X% relative to their total assets. Now, the supplemental leverage ratio only creates a problem when QE is really in force, because when the Fed is doing QE, it's adding deposits to the banking system. It's forcing banks to grow their assets. And as the Fed does QE, that makes the supplemental leverage ratio more binding. So that creates a conflict here, because on one hand, the Fed's trying to make monetary policy more stimulative when it does QE, but as it's doing that, the supplemental leverage ratio is becoming more binding on the banks that it regulates. We think this could be solved very simply by exempting reserves from the supplemental leverage ratio. We think this is justified because reserves don't have any risk. They don't have any credit risk. They don't have any liquidity risk. So if you exempted reserves from the supplemental leverage ratio, it's not going to create any problems for bank safety and soundness. But then it would eliminate this conflict between monetary policy and bank regulation.
Is there
And the
any
last thing
argument in the other direction? I mean, I
pardon me?
don't see any. Is there any argument in the other direction, a countervailing argument? I don't see any argument why you should not do that.
I don't either.
Okay.
There's some people. The only argument against it is like, okay, if you exempt reserves from the supplemental leverage ratio, supplemental leverage ratio today will become less binding. Now, one thing you could do is you could exempt reserves from the supplemental leverage ratio and then increase the percentage of the requirement for supplemental leverage. So it's the same degree of bindingness as it is today. I don't feel strongly about whether you do it or one way or the other. I just want to get reserves out of the supplemental leverage ratio to fix this problem.
So
This
Robert
is
is asking, would you also exclude then also T-bills?
I think that's a different set of issues. I think the excluding T-bills is really about treasury market function, the ability of the primary dealers to provide support to the treasury market during times of stress. You might want to make other changes to the supplemental leverage in terms of the treasury market to support treasury market functioning, but not from a monetary policy framework objective. So we just stuck to the reserves in this paper because that's the scope of what this paper is about.
I'm just going to jump for a second, just because I think Marcus and Bill, you're actually right. There's the argument for including central bank reserves is fairly weak. I think the concern on the other side, to Marcus's point, is that regulators are worried that once you open up the leverage ratio, that other requests will come in, including exempting government securities. And while any particular country might feel that they're riskless in their own country, certainly this is a global rule, and there's already been a lot of discussion on the capital side about the risk weighting on sovereigns and why it shouldn't be the same and zero for everyone. So doing this on the leverage ratio, opening that whole discussion up, or risking opening it up, is viewed as a dangerous path, slippery slope to go down.
Now, yeah, people make the slippery slope argument, but I always push back and say, well, you decide whether you want to go down the slippery slope. It's not like the slippery slope just sort of takes you down automatically. So it's really up to the Fed and other bank regulators to decide how they want to make this adjustment. But this is an example of how monetary policy is not really synced up with bank regulatory policy. The very fact that the supplemental ratio didn't exclude reserves in the first place, because this was an inevitable conflict that was going to arise if the Fed ever did QE in the future. And that really leads to our last point. We really think that when you're doing monetary policy, you need to be thinking about monetary policy in the context of bank supervision and financial stability. So if you do something in the bank supervision regulatory world, and that has consequences for monetary policy, you want the monetary policy makers to weigh in and say, is that a good idea or not? I actually tried to get the supplemental reserves exempted from the supplemental leverage ratio when I was at the Fed. And I was basically told, I'm really sorry, the train is too far down the tracks. We can't undo it at this point. No one really was arguing that my argument was wrong. Just that, no, the regulators had already decided that they were going to do this for bank regulatory purposes. So it's really important to have everybody in the room when you're making decisions in one area that affect other areas. The same thing with QE and financial stability. I mean, the fact that the Fed did massive QE, that did expand bank balance sheets, and that did contribute to the Silicon Valley Bank and First Republic Bank failures. So I think that just needs to be considered when you're doing that on monetary policy that might have some consequences for other areas. Obviously, the appropriate reaction then would be basically to get the bank supervisors really focused on the risk of interest rate mismatch among regional banks. And, obviously, if the Fed had done a better job on supervision, maybe we could have avoided that.
Ask you a question on this, because there's a big debate whether there should be a Chinese wall between the bank supervisors and the monetary policy. In particular, in Europe, you have the SSM being part of the ECB, but there's a Chinese wall between two. You would get rid of the Chinese wall, or is this pushing it too hard?
Yeah, I think that when actions in one area affect outcomes in other areas, you want to have people in the room talking about it to decide, is this really worth doing? I mean, it's sort of like a cost-benefit analysis. You want the cost-benefit analysis not just about monetary policy, but the cost-benefit analysis extend to other areas where the monetary policy could have significant impacts. So, I think there's this whole debate about whether central banks should be involved in bank supervision. And that debate has been ongoing, and sometimes in bank of in the UK, for example, what Carolyn's very familiar with. At times it's been mushed together, at times it's been taken apart. I personally think that there is a need for the central bank to have some insight into the banking system, because if you don't have that insight, you can't do a great job in terms of thinking about financial stability. And if you don't do a good job on financial stability, then monetary policy is ineffective. I mean, to the slide that you presented at the very beginning, Marcus, where you said financial stability is a goal of monetary policy. Yeah, it's a goal of monetary policy, because if you don't have financial stability, monetary policy is ineffective. You basically cut the transmission from monetary policy to the real economy. So I think it's important to make sure you understand these linkages.
Very good. We have a concluding slide now.
So to wrap up, we're glad that Chair Powell did the 2020 framework review. We think it's appropriate to do this, and we're glad that he's doing one in 2025 as well. The reality is you learn lessons through every economic cycle, and from those lessons you find out the strengths and weaknesses of the framework that you had at the time. The structure of the financial system also changes over time. So what might be an appropriate framework at one point in time might not be an appropriate framework in the future. The idiosyncratic nature of the federal funds market is a good example. We've targeted the federal funds rate for the last 20, 30 years. And so that's just what we've done. But the structure of the federal funds market has changed pretty dramatically as we've moved to an excess reserves regime. So maybe this tells you it's the time to move on from the federal funds rate as a target. So doing these kinds of things periodically, I think, is important. We think that the 2020 framework was designed for a low inflation world, and it turned out to be pretty poorly suited to what actually happened during the COVID pandemic. And so we are arguing for a framework that's robust to risks on both sides of the dual mandate objectives. And I think the Fed's going to take that on board. In the FOMC meetings, we've already seen some discussion about the Fed's monetary policy framework review. And the word that the FOMC participants use is they want a framework that is robust. And I think what they're saying by robust is that we want a framework that's suited for all seasons, seasons of economic weakness and low inflation, but also environments where inflation is high and the economy is overheating.
I'm sure that the Fed review, it will flow into the Fed review, and will also be adopted, some parts of it. Let me widen the questions at the end. We're running way over time, but I will just throw one more question at you. And it's a double question. One is, do you think doing a review every 5 years is the right frequency? Would you do it every 5 years? Do you think, oh, it's better every 7, 8, or 10 years, or even every 2 years? So what's the optimal frequency? And then I know that Caroline is also affiliated with the Bank of England. Perhaps look beyond the Fed, and the ECB is also conducting a review at the moment. What are the lessons you have outlined here also relevant for the ECB, for Bank of England, Bank of Japan? Is there anything, or Bank of China, is there anything we can translate here? For example, the ECB was introducing a symmetric target last time. They always had, below 2%, but close to 2%. The last review 5 years ago had a symmetric target. Are there any lessons you've encountered here for the Fed review, which would also translate for the ECB, the Bank of England, or any other central bank?
I'm going to take the simple first question. I'm going to give Carolyn the more complicated second question. So the right frequency. I mean, I don't think that I think 5 years is a reasonable frequency. I mean, it's just the fact that you have a framework doesn't mean the framework can't evolve in the interim. So if the Fed discovers something or comes up with a great idea that the framework they have today could be improved, there's nothing through the framework review process that prevents the Fed from making changes in the interim. I think 5 years is a good interval of time, so there's time to learn from to see how the existing framework has actually performed. It's more sort of tied to the sort of the length of the business cycle, so that seems sort of appropriate. But you don't want it to be so infrequent that it becomes like this hugely consequential activity. And 5 years is also pretty lines up pretty well with the term of the Fed chair. So it sort of gives it's going to give most Fed chairs a chance to take a look at how the Fed conducts monetary policy with a sort of fresh view. So I think 5 years is a good amount. I think the fact but you do want to have it done systematically because it creates a discipline. It sort of forces you to look at how you've done things and look and see where there is room for improvement. If you don't have a periodic or framework review, it's much easier just to kick the can down the road and say everything's fine here. We don't need to change anything.
Yeah, I would just add Bank of Canada has been doing every 5-year review since the beginning, and at times you feel like you just did one, and so it feels short. At the same time, you can tailor the scope of the review to what you think are the real questions at the time, and the advantage of doing it every 5 years is you're just reinforcing your commitment to, even if you don't change anything, it's reinforcing the commitment to doing what you're doing. The difference I've seen in different countries. So RBA did an external review. So it was their first one, but it was commissioned by the government, and in fact, it was entirely external. I participated in that. I'm doing one for the Riksbank right now, and they have a history of doing reviews every 5 years. The Parliament committee is the one that decides the scope, and it's entirely external. I think there's an advantage to having the external review, or at least stronger input from external people, because you get a fresher look. You're less invested. In terms of the lessons that I think are relevant for other central banks, I don't want to pick on any particular one. I would say that on the framework itself, whether you have a dual mandate or a single mandate, you're always thinking about the real side of the economy, and you are faced with trade-offs, and especially if you're in a flexible inflation target regime. And so explaining how you're making those trade-offs, I think, is important in all of those frameworks, and that's something that I'm not sure any central bank has a monopoly on doing it perfectly. And the second thing is related to the frameworks around forward guidance, QE, QT. Those are things that tripped up central banks across the world. You think about the Bank of Canada, the RBA, maybe not so much in the UK. And so thinking through those frameworks and the communications tools that go with providing forward guidance, but at the same time having the right amount of uncertainty understood that goes with it, the conditionality, is something that central banks need to improve on.
If I add one final thought, Marcus, I think doing this well is really important for the credibility of the central bank, and And I think the credibility of the central bank is really important in terms of the central bank ability to maintain its independence. So I'm really hoping that the Federal Reserve takes advantage of this opportunity and doesn't respond to the pressure from the Trump administration by deciding, oh, let's just make minimal changes. We don't want to admit that there were any shortcomings. That would be, I think, a mistake. I think they should basically do what they think is appropriate to make the framework as good as possible. And by doing so, I think they basically would be taking steps that enhance their credibility and reinforce their independence.
I think the good news is that the central banks know they have lessons to learn. It's not as if they think they were perfect. And if you look at what the Bank of Canada has done, the RBA, and others, they're doing their own reviews, or they're responding to the reviews that have been done in a really positive way, because they understand just what Bill said. They want to maintain and build their credibility, and with that, their independence. Then that's what you need to do.
So we're coming back where we started out from. Essentially, it's very important to do these reviews in the public eye, broad public eye, to maintain the independence of central banks, because monetary pressures will be building up given the high public debt level and other challenges we face. I thank you greatly and thank everybody for watching, and I hope to see you next week again with Penny Goldberg talking on industrial policy and globalization. Thanks again, Caroline. Thanks again, William. I talk to you soon.
Thank you, Marcus.
Bye-bye.
Appreciate it. Bye-bye.